Hey, it's Kelly Willis Green, and this is Serious Coin. Over the years, I've met a lot of people who, despite being highly skilled and confident in their own field of expertise, tell me they are completely bewildered when it comes to choosing a money manager. Or they don't know how to differentiate between firms because, let's face it, everybody talks a good game. And I was talking about this recently over dinner with my friend Biff Matthews and his wife Sue. And in the course of that conversation, it occurred to me that Biff would make a perfect guest for this podcast because he's articulate, seasoned, and senior in the investment industry, and he's now retired, which means he has no vested interest in selling anybody anything. In fact, Biff Matthews has studied and written about what works in investing for more than 20 years. He currently writes a column for the Globe and Mail, which for listeners outside of Canada, that's the country's national newspaper. And over the course of his investment career, Biff has founded 2 different successful private wealth firms, Manitou Investment Management and later Longview Asset Management, where he's chairman emeritus. But before entering the investment industry, Biff was a corporate lawyer at a prominent Toronto firm. And before that, he was a graduate of the University of Toronto and Oxford University. You're about to hear Biff and I swap views on some of the factors you may want to consider when you're choosing a money manager or assessing the one you already have. I share my thoughts and opinions because I also worked in the private wealth industry for 25 years as a marketing and communications professional where I worked shoulder to shoulder with top money managers. Here's our conversation. Why don't we start at the beginning then? Let's assume that someone's decided they're going to use a third-party money manager, right? And they're starting this search. What should they start with? What should they determine from themselves before they even talk to a money manager?
Well, it's a great question. I think you've got to decide what exactly you're looking for. And it seems to me that the real value that a money manager provides tends to be the more holistic advice as opposed to just the return on investment. And so I think you should be looking for somebody who's prepared to sit down with you and plan your financial future, as well as being prepared to manage your money for you.
And I want to come back to that planning piece as well. You know, you and I have worked in this business for decades,
Sure.
And we know some of the firms. We know some that are very good, some maybe we wouldn't necessarily invest with. So where do you think people should start looking as sources if I'm putting together a list of money managers that I might want to go and talk to?
I mean, I think I would say talk to your friends who might be using money managers and try to get some names from them. My own view is it kind of comes down more to the person than to the firm. And you want somebody you're going to be able to get along with, you're going to be able to relate to, and so on. And that could be somebody with a big firm or a small firm. But I think I'd personally start with people I know who have used money managers and find out what their experience has been like.
I always think, believe it or not, I think the internet is a good source as well.
Sure.
Visiting the websites, different firms give you a different kind of feel.
Yes.
Some feel very clinical and institutional. Some may not be suited to you as an investor. When you mention choosing someone you feel comfortable with, I ask people a lot, entrepreneurs, people on this podcast, what could advisors do better? And the thing I hear over and over again is listening.
Yes.
I think that relates to what you're saying about someone you can feel comfortable with.
Yeah, that's a very good point. And, it's interesting. I think it applies to doctors and lawyers and teachers and a lot of other people too. We could all benefit from listening a little more.
And then also showing that you've listened by coming back with some customized recommendations, not just cookie cutter approaches, because that's the other thing I hear.
Yes.
But okay, now the flip side of that is, in my experience, sometimes people put too much weight on someone they're comfortable with, when in fact, the investment capabilities may not be that strong, or the fees may be far too high, or the firm may not have that great a reputation. Sometimes you can get really comfortable with the person and put too much weight in that.
Yeah, I would agree with that. I mean, I think one thing you should do if you can is assume you know nothing about the stock market, the bond market, et cetera. I think you should try to do a little reading on your own. Not everybody's going to do this, but if you can, you should. And there's quite a few general books out there. I'd recommend two that have been around for many years, sold millions of copies, and get updated about every 4 years are Random Walk Down Wall Street by Mulkeel. And the other one would be The Only Investment Guide You'll Ever Need by Tobias. And they've been around, I think, probably 25, 30 years, but they get updated regularly. And I think the advice is good and they're not hard to read.
Okay, that's great. That's a good starting point.
And that just gives you a framework.
Exactly. Okay, so let's get into the next layer. Now you've got a list of firms that you want to go and see. You're putting together a list of questions and criteria. Let's start there. What should people ask? And just as importantly, how should they make sense of some of the answers they're getting? Why don't you kick it off with some ideas?
Sure.
And I'll jump in with some of my own.
Sure. Well, I mean, I think in terms of, let's just talk for a moment about returns. Some firms unquestionably are better than others. And so I think what you want to know is, and let's just assume we're talking stock market returns for the moment to keep it simple.
Right.
I think you want to know what the 10-year return has been for the firm. I mean, 1 year is meaningless, and even 5 years, in my view, isn't enough. You want a long-term return. And if you want a rule of thumb over the last 10 years, which has been good for the stock market, you probably want a return of 8% or better. That's very arbitrary, but I mean, I think it's a reasonable thing to say. And when I've looked at these firms, what really struck me is how atrociously some of them have done.
Mm-hmm.
I mean, not all of them, but there's one or two, often the ones that charge the largest fees and have the fanciest board of advisors have just terrible returns.
Yeah.
So you do want to look at the returns. And then I think you also want to talk to the people about what other services they would provide for you. And again, I'm back to this notion that I think you want somebody who's going to provide holistic advice as to your financial planning throughout your life.
Now, on returns, I think the other piece of the performance equation that doesn't get as much emphasis is volatility. So rate of return, you're saying 8-ish, but then there's the question of how you get there, right? And the degree of fluctuation in your capital to that 8%. And that can vary widely. So what would be some of the metrics or measures or questions people should ask to determine the level of volatility in those performance figures?
You could ask the firm to compare their level of volatility with that of the market. And you would expect it. And there are measurements for that, which we don't have to get into right now. But and you would hope it would be less than the market more generally.
Exactly. I mean, look, I'm a nervous flyer. And so if I could be guaranteed that I could get to my destination with less turbulence, and even if I have to pay a little more for it, I'm going to do that.
Right.
And I think that for many investors, that's true, because it's in the periods of volatility where they're tempted to do the wrong thing. Leads me to, as you know, one of my investing heroes is Peter Lynch, who managed the Fidelity Magellan Fund in the 1980s. And I worked for Fidelity in the mid-90s, so Peter Lynch was long retired, but he had astonishing rates of return, right? I think it was something like 29% a year. But the average investor in the Magellan Fund lost money.
Sure.
And you say, like, how is that possible? But it's actually quite typical because investors often do the wrong thing at the wrong time. What trips you up is not the investments you make, it's the bad timing decisions around those investments, all relating back to volatility.
Right. No, that's a very good point. So I think there's sort of perhaps two separate points there. One is just how important is it to you to avoid volatility? And I think that is quite particular to the client. And some clients really don't want volatility, and some are quite happy to have it. I mean, Buffett has sort of famously said, "I'd rather have a lumpy 12% than a smooth 10%." And so you've got to know yourself a little bit there. And then the second point is very, very good point, that people often sell after the market's dropped, and that's the worst thing you can possibly do. So you need an advisor who's going to be able to prevent you from doing that, talk you out of it. And part of that is just explaining how the market works, the fact that these companies have an economic value as well as a price, and you shouldn't be too worried when the price drops as long as you know the economic value is there. So you need somebody who can sort of talk you through that a little bit, and you have to have a good relationship with the person.
As you say that, I'm reflecting on your comment, which I think is a very good one. You should really measure returns in terms of 10-year periods. And for a manager to truly outperform, they're going to look wrong sometimes, very wrong, within those 10-year periods typically,
For sure.
right? Otherwise, they would be tracking the index. And so I think you also have to have faith that they have the right approach, that they know what they're doing, that the strategy still holds in those periods, which maybe goes back to our point about doing your due diligence up front and making sure that the strategy is really sound. Thoughts?
Yes. Yeah, I think most of the outperforming managers have had, bad years when they underperform the index. It's just a reality.
Okay, so now I'm going to go into the lion's den. and I want to ask you about the article that you wrote recently in the Globe and Mail, in which you make the argument that passive investing is a better alternative for most investors than active investing. And I'll let you explain the difference and your argument around that.
Okay, well, I think there's kind of two almost conflicting statements here.
Okay.
One is, if you want to maximize your return, you should buy a passive index and leave it alone. And if you do that, in the long run, you're going to beat more than 90% of the managers. And you can't predict which managers might outperform in advance. So clearly, if you're just looking for outperformance, investment return outperformance, I believe passive is the way to go. And there have been numerous studies on this starting from the 1970s on, and I've never heard anybody disagree with that unless they had a financial incentive to disagree with it.
Right.
So anybody who's looked at it objectively has come up with the same conclusion. Now, the other statement, which goes in the other direction, is most people don't want to do their own investing. And if you buy an index, you're doing your own investing.
And just to be clear, buying the index means ETFs or index funds. You can't actually buy the index.
Yes, thank you. Yeah, either an index fund or an exchange traded fund. And for example, Vanguard has an exchange traded fund. The symbol is VT. And I think they call it the All Stock Market Index. It's a global index. It's got something like 10,000 companies, and it's all the stock markets around the world. And they charge 7 basis points. So that's less than 1/10 of 1%, which is very, very low. And if you were to buy that and put it away, you'd do extremely well. But you're investing your own money. And I mean, I don't want to repair my own car. And a lot of people don't want to do their own investing for the same reason. And I totally get that. So that's why you might choose a money manager instead. Give up a little bit on the return, but get the advice and the holistic service that we talked about earlier.
And would it be fair to say that an active manager would have less volatility?
Well, typically they do. I mean, partly because, for rightly or wrongly, they often sit on some cash. And that alone will reduce the volatility.
Yeah. If you had another reason that managers find it difficult to outperform, and it's a term I'd never heard before, called the paradox of skill. Can you explain that?
Sure. This was, I think, originally conceived of by a biologist at Harvard, Stephen Jay Gould, who was studying baseball teams. And what he discovered is that as baseball players got better, in fact, the difference between the best player and the median player decreased. And you can kind of expect that. I mean, imagine a village has a baseball team, and you're going to find some players are much better than others. And then instead of it just being the village team, it becomes the county team and everybody else comes in. Now you're going to have a higher level of play, but there's going to be less difference between the very top and the average. And this is what happens in all sports, and it happens in investing too. As people become better educated and more informed, there becomes less and less difference between the very best and the average. And this means that there is going to be more luck and less skill involved in investing as time goes by. And just a sort of little background to that, a guy called Michael Mauboussin did a study and concluded, the study would be about 10 years ago, that investing was, and this is pretty surprising to me, I think it's surprising to most people, is about 85% luck and 15% skill. And I think Mauboussin would say today it's even more than 85% luck. So if he's right, and I think he is, that investing is more luck than we would have thought, then clearly what you want to do is reduce the detractors, and those are fees and taxes. And so if you go the passive route, you're paying less fees. And because there's less turnover, buying and selling in the portfolio, there's also less capital gains tax. So that's the argument for passive. I mean, essentially, if you were to buy, say, the S&P 500, you're buying a piece of all the stocks that are in that index. And the annual turnover is less than 5%. So in other words, there's very little change in that portfolio. And so you're going to be paying, if you own that index, you're paying very little capital gains tax in a year. If you go to a money manager, they might have a 30% portfolio turnover, which means there's more capital gains tax to pay in the year. And so that's essentially the difference.
And turnover being the number of securities that change in a portfolio in any given year.
Yes.
Yeah.
Yes. Yeah.
And fees. Whoa, that's another whole hornet's nest. There's a lot of opaqueness to how firms report these things.
Right. If somebody's got, be a little arbitrary here, but let's say you've got $5 million to invest with a money manager, seems to me you should be paying less than 1%.
Yeah.
If you've got less money, the reality is you're going to wind up paying a higher percentage of your capital in fees. And as you know, Kelly, firms are all over the place on this.
So we were building a list here of some of the considerations to think about when you're assessing a money manager. And I'll try to recap a few of them here, just so you have it clear in your mind. There's performance, of course, and that is made up of both the rate of return and volatility. And your manager should be able to provide you with the statistics that measure volatility. I thought Biff made a good point that as a client, you want to be really honest with yourself about the amount of volatility that you're going to be comfortable with. And sometimes you don't always know that until it's tested. Fees are important and they get a lot of media attention. But in my experience, they're not as transparent as they could be. So you may need to press on this point and dig a little with your manager to truly understand the direct and indirect costs that could impact your invested capital. And you shouldn't be shy in asking the questions. Lastly, Biff mentioned turnover. Again, that's the amount of activity, the buying and selling within the portfolio. And high turnover can generate capital gains taxes and trading costs that can eat into your portfolio. My advisor has a great saying that your portfolio is like a bar of soap. The more you handle it, the smaller it gets. One obvious area we didn't discuss is the manager's investment strategy. Is it well explained? Do you understand it? And do they apply it consistently in all market cycles? Biff and I went on to talk about whether he thinks the size of a firm is important.
I think if you're choosing a money manager, you do want to have somebody with a 10-year track record. You need to see that. I don't personally think there's anything wrong with a very big firm or a very small firm if you've got the right person doing it. So there are some good small firms out there without question. And we always used to think the banks weren't as good as the independents, but even in the banks, I'm sure there are a few good people who who you'd be happy to have as your advisor. So I think it does, to a large extent, come down to people you're dealing with.
I admit it's been my bias for some time that independents are the way to go.
Sure.
It's just less conflict.
Yeah, no, that's right. I mean, that's fair. Sometimes in the banks, they're told they have to do certain things that don't necessarily put the client's interest first.
I think another thing people should think about is the transparency of the firm, how they present the results, how they present their philosophy. I mean, I'd love advisors to be more candid about the mistakes that they've made, maybe what they've learned or how they fix them. Everybody's quick to talk about their wins. I've been at an investment presentation sometimes and they'll talk about this stock and that stock and when they got in, how well it did. And I leave the presentation thinking, why is my portfolio not up 20%?
Yeah, exactly. Yeah.
And I think particularly with the ultra wealthy, they sort of have a built-in cynicism chip about how you present things.
I think that's a good point. I mean, Buffett has always been transparent about his mistakes. And some of the firms I know of are also quite transparent about their mistakes. And that's always a good thing.
Another factor for some people is Madoff. Particularly, as you say, if people are new to this and they're investing with a professional money manager, they worry about a Madoff type event, particularly when they're going with a firm that maybe isn't a household name. They worry about a firm going insolvent. Those are certainly rare, but devastating events. What kind of checkpoints or questions should people be asking to assure themselves that that's not going to happen?
Well, in the case, hindsight is always 20/20. And in the case of Madoff, the 2 points that everybody made afterwards was, one, he didn't have an independent auditor. The auditor he had was doing his work and pretty much nobody else's. And two, he didn't have an independent custodian. He owned the custodian was a company he owned. So right away, if you're suspicious, you should have picked up on those two. So if you go to any reputable manager, they're going to have a large institutional custodian that's holding your money. And so there's no danger of your losing your money, even if the manager goes out of business, because the custodian's got it. And you've got a direct contract with the custodian. And then you want to make sure that they're using a real auditor that has other clients and so on. So I think those are two things to check on. But it's really not, because of the custodial situation, it shouldn't be an issue for people.
Switching gears, we've talked about how clients should interview investment firms, but I've often thought investment firms should interview clients to make sure that there's alignment of expectations.
Yes.
You had many clients in your career. What makes a good client?
Well, it's a great question. I mean, I think a good client is somebody who is interested in their money and what you're doing with it, and is interested in things like tax planning and financial projections, and who's paying attention. You're quite right. I mean, I can think of one example of a lady who came in and became our client. And in hindsight, I should have known right away that she didn't have any idea what this was all about. And a very nice lady, very intelligent. But the minute the market went down, she took her money out. And I thought we'd explained that could happen, but obviously I didn't get through to her. So yes, we should all be more careful with who we take on, I think, as clients. It's quite right. One huge aspect of it is that, a year in the stock market is a blink of an eye. You've got to take a longer view of all this stuff. And I always use the example of if you're trying to figure out if a coin will come up half heads and half tails, you could toss it 1,000 times and you'll know it's half heads and half tails. But if you toss it 4 times, anything can happen. And if you invest your money for 6 months or a year, anything can happen, and it doesn't mean a thing. It's just noise. So teaching people to take that longer view, I think, is an extremely important part of the whole process.
You're right. I mean, we've talked about active management, passive fees, high fees, low fees, no fees. Governing your own behavior as an investor, I think, is the most critical factor.
Yeah.
And so maybe what comes out of this is people think about that and set their own expectations, and however they do it, learn to develop patience and that 10-year minimum time frame.
Yeah, I mean, we're hardwired to think short term, and we're hardwired to worry much more about losses than gains. And so you've got that working against you. And if you can, as an advisor, if you can explain that to people and get them to recognize that they're really not hardwired to look at this thing rationally, and you have to take a longer term view, you have to be patient, then you're doing them a favor. But it's not easy.
No, it's definitely not easy. But do we make it more complicated than it should be? I sometimes wonder if I do. I'm always trying to optimize every decision and gain that edge. Biff sent me one of Warren Buffett's shareholder letters on this subject. And I'll paraphrase here, but Buffett wrote that since wealthy individuals are so accustomed to the rare and the bespoke, that even in their choice of financial services, they seek exclusivity. There are no bragging rights in a portfolio of index funds. And Buffett calculates that over the course of a decade, the elite's relentless search for superior investments has destroyed more than $100 billion of portfolio value. That got my attention. And here's what Biff had to say about that.
Well, I think there's some truth to that, but I hate to contradict Warren Buffett, but the reality is most people are not as rational as Warren Buffett.
Yeah.
And most people are not as comfortable making their own investments as Warren Buffett. So I can think of people I know who are not using a money manager because it's a fancy thing to do or they want to show off or anything like that. They just don't want to be making those decisions themselves in an area where they're not comfortable.
Yeah.
So I think there's a lot of truth in what Buffett says, but there's a little more to it than that.
And I think there are also certain areas of the market. Now, this is not so much public securities, but if you wanted to invest in private debt or, say an opportunistic credit strategy, I mean, you almost have to choose an active manager for that.
Yeah, that gets us, there is the whole question of what asset class you invest in, and that's a whole other kettle of fish.
That's a whole other episode.
Yeah.
We'll have to come back and tackle that one. Many people like to use more than one manager. Lots of reasons for that. What do you think? What are some of the pros and cons of having more than one manager?
Well, I think the obvious con is that your percentage fee is usually varies inversely with the amount of money you give the manager. So giving all your money to one manager means you're paying a lower fee. So that's
significant.
That's the con to having a bunch of managers. If you're starting out, and maybe some of the listeners will be starting out, I think it may make sense to use up to 3 managers initially, and then whittle it down to probably 1 over time, once you see what sort of service you're receiving and also returns. But I think service may be more important than the returns.
And why do you say when you're starting out?
Well, if you're starting out and you just don't know much about this and you're still finding your way, you really don't know what sort of service you're going to get from any manager based on the pitch they give you. Mm-hmm. Because everybody, makes themselves look as good as possible in the pitch. And it's only after a few years with a manager you really know what's going to happen.
I think the other negative from my perspective, although we do have multiple managers, is time. You have to meet with these people.
Yes.
And busy schedules.
Oh, yeah. No, that's a good point.
You've talked about the holistic services and the fact that many managers don't outperform. So if the role of a manager isn't to beat the market, what is the role of a manager?
Well, I mean, I think increasingly we will see fewer people involved in investment management as there is a shift from active to passive. But I think these firms still have a role to play. And it's kind of what we talked about earlier. I think everybody, just to back up for a moment, I think everybody should have a tax accountant. And that's almost the first advisor you need. But in addition to that, you want to find a firm that understands taxes and can talk to you about your taxes and what's a tax efficient way to invest. I think you also want somebody who can give you a financial projection. And maybe they would say to you, for example, look, I think your stock return over the next 10 years is likely to be roughly 8%, but for planning purposes, let's assume it's 4.5%. And let's take that forward and see where you're going to be in 10 years and 20 years and 30 years and how much you can spend, how much you have to save, all of that sort of stuff. Because I think that's very important.
What about if you're talking to people who will never run out of money? They can't spend it, but they still don't want to lose their relative standing. I think they've got a different set of objectives. And I think about inflation. I don't know whether have you seen the Forbes magazine puts out the cost of living extremely well index?
No, I haven't seen that.
So they take a basket of luxury goods and services, and they calculate the rate of inflation attached to that basket. Basically, it is the cost of living well. And what they seem to find each year is that inflation is significantly higher than the consumer price index.
Right.
So in other words, it's getting more expensive all the time to be rich.
Yes.
and so I have yet to see a financial plan done where they peg the rate of inflation at 5, 6, 7%, which is what this index seems to show. So what is the rate of inflation, I guess? What is the rate of return when you want to preserve your relative standard of living?
Well, I think, again, if we keep it simple and just talk about stocks for the moment, long-term, stocks have given you inflation plus 6%. And that's assuming a 3% inflation rate. And let's just say that the inflation rate isn't 3%, it's 5% for the sake of argument. You're still
ahead of that.
Well ahead with a 9% return on your stock. So I think you can get there. You just have to put enough money in an asset class that's going to give you well above inflation.
I'm sure there are people listening to this who hear us talk about 8% and can't get very excited about that. I know certainly when I was working in wealth management, again, I was not an advisor, but I would do discovery calls with potential clients. And a lot of people who made money quickly, who made money in very high margin businesses, really just had no interest in an 8% return. Have you experienced that?
Well, one thing I have noticed is it sort of depends to some extent on what the stock market's done recently. So in 2000, I can remember people coming in and saying, I'm not greedy. I just need 15% a year.
Right.
And, which was, if you take a long-term view, that's absurd. And then once the stock market crashed, people were quite happy to give me 5% a year. I'll be perfectly happy. So I think it varies a lot. Entrepreneurs have quite a different mindset from long-term investors. And so I would agree they can be challenging clients.
I'm married to one. He doesn't like the stock market much. You have an interesting story. I want to talk about you a little bit because you had a successful corporate law career and you left it to enter the investment industry. How did that come about? When did you decide that investing was more interesting than law?
Well, the only thing I'm embarrassed about is how long it took me to come to that conclusion. So I was a business lawyer with a large, for most of my career, with a large Toronto firm. And in business law, you have to know the relevant law and you have to understand your client's business. And I always found the business issues to be more interesting than the legal issues. And I can remember one day I was talking to a client about a transaction and he asked me a question and I said, well, that's just a legal issue. And he looked at me funny because of course I'm a lawyer and I realized maybe it was time to change careers. The other thing that happened in around 1990 was I read an article in Fortune magazine about Warren Buffett. And for whatever reason, it made a huge impression on me. And we talked about the fact that if you understood business, you should be able to estimate the economic value of any business out there. And sometimes excellent businesses would trade at less than half of their economic value on the stock market, at which point you should obviously buy the stock and put it away and hold it for the long run. And that just made enormous sense to me. So I started going down to the Berkshire Hathaway annual meetings and did that for a number of years, and then eventually decided I was going to leave the law and set up an investment management firm.
I've always wondered what it would be like to attend one of those meetings. What was it like the very first time? Do you remember?
Oh, the first time was terrific. I remember I sat, it was in a smaller venue at that time because there were fewer people going. And I sat beside a German woman and I started talking to her and I said, well, why are you here from Germany? And she said she'd been an au pair in Omaha 30 years earlier, bought some shares of Berkshire Hathaway. And of course, that was the period, sort of 65 to 95 or something like that, when they really took off. And so she was a very wealthy woman. And so she'd come back from Germany with her son to hear what Warren Buffett had to say. So it was great.
Yeah, that's neat. So what was your first move then into the investment industry?
I started a firm. I had a few friends that I knew would give me money if I started a firm. So I just started a firm from scratch. I had a good friend by the name of Steve Scotchmer who sort of co-founded the firm with me, and we hired a guy to do the research, and we sort of built it from there. And you lose money for at least 2 years, but it doesn't. It's a pretty good business, actually.
Well, there's that old adage about don't buy the mutual fund, buy the mutual fund company's stock.
Yes, yes, that's right.
I loved that story of the German au pair who became wealthy through her Berkshire Hathaway shares. Talk about banking your babysitting money. And no doubt she was a patient investor who practiced, I'm sure, a lot of the disciplines that Biff was talking about. Next up, I put Biff through my usual roundup of quick answer money questions. If I would ask you to finish the sentence, to me, money is...
options to be able to do things I couldn't otherwise do.
Do you think that having money changes people?
I think generally not fundamentally. I think people, if somebody thinks that their status in society has radically changed up or down, they might behave differently. But most of the people I know don't equate status with having a lot of money. So I don't think most people are changed by it.
Which, in your view, is more challenging, creating wealth or managing it?
Yeah, well, I think creating wealth is tough at the beginning, making your first $1 or $2 million or whatever it is, and then it gets pretty easy. And I think managing money, it's just the opposite. It's once you've got a chunk of money, it's not that difficult to manage it. But towards the end, when you've got too much money, and it starts to interfere with your family and the way people are behaving, then it becomes more challenging. So I think one's tough at the beginning, the other's tough at the end.
I have never heard it put that way. Great insight. How do you define true wealth?
Well, I don't think it has much to do with money. It's essentially being loved and respected by people by whom you want to be loved and respected. Life is mostly about relationships, and so that's what true wealth is.
Well, I hope that conversation gave you some food for thought. And I know we just skimmed the surface, but hopefully you took away some hints and reminders that will help you feel more informed and emboldened to do your own research and find the investment approach that's right for you. I really want to thank Biff Matthews for being my guest. It was fun, and I always learn something from every conversation I have with him. Biff mentioned 2 books, The Random Walk Down Wall Street and The Only Investment Guide You'll Ever Need, and I put links to both in the show notes, along with a link to the article Biff wrote for the Globe and Mail entitled, Why Is It So Hard to Beat Index Funds? With the proviso that it is paywall content, so you may need to be a subscriber to access it. Thanks for listening to Serious Coin. I'm Kelly Willis Green. We have the final episode of Season 5 coming up. We're going to be talking about luxury. Make sure you're subscribed so you don't miss it. Serious Coin is provided for your general interest only, and nothing we discuss should be taken as investment, tax, legal, or other professional advice. Always talk to a licensed professional before you make any financial decisions.